Thanks for joining us today on the 7th of May 2020. You're listening to Ainslie News, and today we are continuing our conversation about Dalio's new book and the end of the long-term debt cycle. Yesterday we summarised the first part of Ray Dalio's new book preview and on the rise and fall of empires over history. And today we dive into how money and credit in large part dictate the rise and fall of these economic empires that typically last between 50 to 75 years. The current economic US empire started in 1945, ominously 75 years ago. When you look at the current economic happenings and that time frame, the penny should drop that this could indeed be the big one of our lifetime. To get the gravity of this, we need to repeat verbatim his two opening paragraphs in this chapter. In order to understand why empires and their economies rise and fall, and what is happening to the world order right now, you need to understand how money, credit, and debt work. Understanding how they work is critically important because of that which has historically been and still is, and what people are most inclined to fight for, is wealth. And the biggest single influence on how wealth rises and declines is money and credit. So if you don't understand how money and credit work, you can't understand how economies work. And if you can't understand how economies work, you can't understand the most important influence on economic conditions, which is the biggest driver of politics and how the whole economic political system works. For example, if you don't understand how the Roaring Twenties led to a debt bubble and a big wealth gap, and how the bursting of that debt bubble led to the 1930 to 33 depression, and how the depression and wealth gap led to conflicts over wealth all around the world, you can't understand the forces that led to Franklin D. Roosevelt being elected president. You also wouldn't understand why, soon after his inauguration in 1933, he announced a new plan in which the central government and Federal Reserve would together provide a lot of money and credit, a change that was similar to things happening in other countries at the same time, and also similar to what's happening now. Without understanding money and credit, you wouldn't understand why these things changed the world order, nor would you understand what happened next, i.e. the war, how it was won and lost, and why the new world order was created as it was in 1945. And you won't be able to understand what is happening now, or even imagine the future. We want to give you two choices today, given our usual promise to present short, sharp articles. First, Dalio's summary, and second, you can cut straight to it, which is a link in the comment section below. We think the summary falls well short of capturing this excellent piece. The full excerpt is well worth the read, but may be better digested after reading the summary first. It is easily the best summary of money and credit as a macroeconomic driver over history we've ever read. And again, you can go straight there in the comment section if you wish. Okay, here's summary. Stepping back to look at all of this from the big picture level, what I'm saying about the relationship between one, the economic part, i.e. money, credit, debt, economic activity and wealth, and two, the political part, both within countries and between countries, of rises and declines, looks like the pictures shown below. Typically, the big cycles start with the New World Order, i.e. a new way of operating both domestically and internationally that include a new monetary system and new political systems. The last one began in 1945, because at such times, after conflicts, there are dominant powers that no one wants to fight, and also people are tired of fighting. So there is a peaceful rebuilding and increasing prosperity that are supported by credit expansion that is sustainable. It is sustainable because income growth exceeds or keeps pace with the debt service payments that are required to service the growing debt, and because of central banks' capacities to stimulate credit and economic growth. It's great. Along the way up, there are short-term debt and economic cycles that we call recessions and expansions. With time, investors extrapolate past gains into the future and borrow money to bet on them continuing to happen, which creates debt bubbles at the same time as wealth gaps grow because some benefit more than others from this money-making upswing. This continues until central banks run out of their abilities to stimulate credit and economic growth effectively. As money becomes tighter, the debt bubbles burst, credit contracts, and with it the economy contracts. At the same time, when there is a large wealth gap, big debt problems, and economic contraction, there is often fighting within countries and between countries over wealth and power. At such times of debt and economic problems, central governments and central banks typically create money and credit and or devalue their currencies. These developments lead to the restructuring of the debts, the monetary system, the domestic order, and the world order. Then it starts again. While none go exactly like that, almost all of them, by and large, go that way. For example, while the debt bubble bursting generally leads to economic contraction, and the economic contraction with large wealth gaps generally leads to the internal and external fighting, sometimes the order is a bit different. However, more often than not, money, credit, and debt cycles lead to economic changes, which leads to domestic and international political changes. And just a few snippets we want to also bring to attention here. To review, in the long-term debt cycle, holding debt as an asset that provides interest is typically rewarding early in the cycle when there isn't a lot of debt outstanding. But holding debt late in the cycle when there is a lot of it outstanding and it is closer to being defaulted on or devalued as risky relative to the interest rate being given. So, holding debt, e.g. bonds, is a bit like holding a ticking time bomb that rewards you while it's ticking and blows you up when it goes off. As we've seen, that big blow up, big default or big devaluation happens once every 50 to 75 years. The recent history in a nutshell. After the 1980s debt restructurings were completed, the 1990s new global increase in money, credit and debt began again, which again produced a prosperity that led to debt finance purchases of speculative investments that became the dot-com bubble, which burst in 2000. That led to an economic downturn in 2000 to 2001 that spurred the Federal Reserve to ease money and credit, which pushed debt levels to new highs and created another prosperity that turned into another and bigger debt bubble in 2007, which burst in 2008, which led the Fed and other reserve currency countries' central banks again eased, leading to the next bubble that just recently burst. However, this time the money and credit creation needed to address this downturn was engineered differently. Short-term interest rates hit 0% in 2000, and that amount of decline wasn't enough to create the money and credit expansion that was needed. Stimulating money and credit growth by lowering interest rates is the first choice monetary policy of central banks. I call it Monetary Policy 1. With this approach no longer available to central banks, they turn to the second choice monetary policy, which we call Monetary Policy 2, which is the printing of money and the buying of financial assets, mostly government bonds and some high-quality debt. The last time they had needed to do that because interest rates had hit 0% began in 1933 and continued through the war years. This approach is called quantitative easing, rather than debt monetization because it sounds less threatening. All the world's major reserve currency central banks did this. That led to the next money, credit, economic paradigm, which has lasted until the economic downturn that we are in now. And now, both long-term and short-term interest rates are around 0% and central banks' purchases of bonds not flowing through to stimulate economic growth and help those who needed it most. It became apparent to me that the second type of monetary policy wouldn't work well, and the third type of monetary policy 3 or MP3, would be needed. MP3 works by reserve currency central governments increasing their borrowing and targeting their spending and lending to where they want it to go, with the reserve currency central banks creating money and credit and buying debt, and possibly other assets like stocks to fund these purchases. The coronavirus triggered economic and market downturns around the world, which created holes in incomes and balance sheets, especially for indebted entities that had incomes that suffered from the downturn. Classically, central governments and central banks had to create money and credit to get it to these entities they wanted to save, that financially wouldn't have survived without that money and credit. So on April the 9th, 2020, the US central government, the President and Congress, and the US central bank, the Fed, announced a massive money and credit creation program that included all the classic MP3 techniques, including helicopter money, direct payments from the government to citizens. It was essentially the same announcement that Roosevelt made on March the 5th, 1933. While the virus triggered this particular financial and economic downturn, something else would have eventually triggered it, and regardless of what did, the dynamic would have basically been the same because only MP3 would have worked to reverse the downturn. The European Central Bank, the Bank of Japan, and to a lesser extent the People's Bank of China made similar moves, though what matters most is what the Federal Reserve did, because it is the creator of dollars, which are still the world's dominant money and credit. And finally, an answer to why the US dollar is in such demand now, but why that may not last. As with all banks that printed reserve currencies, the Federal Reserve is now in the strong but awkward position of running its monetary policy in a way that is good for Americans, but that might not be good for others around the world who are dependent on dollars. For example, the US central government just recently decided it would borrow money to give it and dollar credit to Americans, and the Federal Reserve decided to buy that US government debt and a lot more other debt of Americans to help them through this financial crisis. Understandably, little of that will go to foreigners. The European Central Bank will do something similar for those in the Eurozone. The Bank of Japan, which is still smaller on the world scene, will do the same thing for the Japanese, and the People's Bank of China will do the same thing for the Chinese. A couple of other relatively small countries, like Switzerland, might be able to do something similar for their people, but most of the world won't get the money and credit they need to fill their income and balance sheet holes the way the Americans will. This dynamic of countries not being able to get the hard currency they need is like what happened in the 1982 to 91 period, except interest rates can't be cut significantly this time, while they could be cut very significantly in that 1982 to 1991 period. At the same time, dollar-denominated debt owned by non-Americans, i.e. those in emerging markets, European countries and China, is about $20 trillion, which is about 50% higher than what it was in 2008, and with a little less than half of that being short-term debt. These dollar debtors will have to come up with dollars to service these debts, and they will have to come up with more dollars to buy goods and services in the world markets. So the US, by having the US dollar as the world's reserve currency and having the world's bank that produces that currency, and by having the power to put these needed dollars in the hands of Americans, can help Americans more effectively than other countries' governments can help their own citizens. At the same time, the US risks losing this privileged position by creating too much money and debt. Again, if you have time, it's definitely worth reading the full text here. It's in a link in the comments. Thanks again. This is Ainslie News. We'll catch you tomorrow.